Ladies and gentlemen, welcome to this exclusive discussion on one of my favorite topics, investing. I'm Warren Buffett, and today I'll be your guide through the first chapter of the book, 10 Golden Principles of Warren Buffett. We'll begin with an exploration of a fundamental principle that has guided my investment philosophy for years. In this chapter, I'll delve into the very core of my investment philosophy, the first golden principle: invest in what you understand. This principle may sound deceptively simple, but it forms the bedrock of my entire approach to investing. I want you to truly grasp the profound wisdom behind this principle because it's the key to becoming a successful investor. Investing in what you understand means that you should only consider businesses or industries that you have a deep knowledge of. This knowledge doesn't have to come from formal education or expertise. It can come from your personal experiences, interests, or observations. The point is that you should be able to explain, in simple terms, how a business makes money and why it's likely to succeed. The rationale behind this principle is quite straightforward. When you invest in businesses or industries you understand, you're in a much better position to evaluate their potential for long-term success. You can assess the risks and opportunities more effectively. It's like operating in your comfort zone, where you're better equipped to make informed decisions. I'll share personal anecdotes and experiences that demonstrate the practical application of this principle in my own investment journey. You'll see that I've consistently invested in businesses and industries I could understand well. It's a philosophy that's led me to some of my most successful investments, such as Coca-Cola, one of my all-time favorite stocks. But to truly understand the power of this principle, we'll also discuss situations where I've deliberately avoided investments that fell outside my circle of competence. I'll explain why I've often said that in the investing world, you don't have to swing at every pitch, which means you don't have to invest in every opportunity that comes your way. Knowing your limitations is as important as understanding your strengths. Furthermore, we'll explore the concept of a too hard pile. This is a critical concept that I believe every investor should embrace. While it's natural to focus on the investments we do understand, it's equally crucial to recognize the limits of your understanding. So, I'll walk you through the idea of having a too hard pile in your investing portfolio, an area where you admit that the intricacies of certain businesses or industries are beyond your grasp. This chapter sets the stage for the essential principles of my investment philosophy. By understanding this first golden principle, you'll embark on a journey that's grounded in clarity, simplicity, and knowledge. You'll learn that success in investing doesn't require a complex formula or obscure expertise. Instead, it stems from recognizing your strengths, acknowledging your limitations, and sticking to a strategy that aligns with your understanding. As we navigate through the chapters of this book, you'll realize that these principles are not limited to the stock market alone. They can be applied to various aspects of your life where you make decisions. I invite you to embrace the concept of investing in what you understand and to be intentional in your approach to every investment decision. It's a powerful principle that can lead to a lifetime of successful investments. Now, let's delve deeper into why knowledge is the linchpin of successful investing. While it might seem obvious, the level of understanding you possess about the businesses you invest in cannot be overstated. This chapter will reinforce the idea that knowledge is the cornerstone of my investment philosophy. We'll explore how insights into businesses and industries provide a crucial edge when making investment decisions. To begin with, we'll discuss why it's essential to be able to explain how a business makes money. This is more than just understanding its products or services. It means knowing the underlying financial model that drives profitability. The ability to explain the business model in simple terms is an indication of your grasp of the company. We'll also talk about the competitive advantage, or the moat, as I like to call it. Identifying and understanding a business's moat is a critical component of successful investing. A moat is a sustainable competitive advantage that allows a company to protect its market share and fend off competition. We'll delve into the various types of moats, such as cost advantages, network effects, and brand strength, to name a few. Additionally, we'll explore the importance of knowing the management team. An exceptional management team can elevate an average business, while a poor management team can sink a fantastic business. We'll discuss the qualities and attributes to look for in management to assess their competence and integrity. In this chapter, we'll also touch on the notion of the too hard pile. I've often emphasized the importance of not just focusing on businesses you understand, but also recognizing when something is outside your circle of competence. Sometimes the best investment decision is not to invest at all, and this concept has protected me from costly errors over the years. This chapter will provide you with a practical framework for evaluating businesses. You'll gain a deeper understanding of how to assess a company's intrinsic value and make informed investment decisions based on a comprehensive knowledge of the business. Finally, I'll share some valuable resources and tools that can aid in your journey to acquiring knowledge. Whether it's annual reports, industry publications, or insightful books, there are numerous sources to expand your understanding of businesses and industries. Investing in what you understand means investing in a world of businesses. It's about recognizing that when you buy a stock, you're not just acquiring a piece of paper with fluctuating numbers, you're becoming a part owner of a real company. This chapter delves deeper into viewing stocks as ownership in actual businesses and the profound implications of adopting this mindset shift for investors. First and foremost, let's address the difference between a stock and a business. A stock is a representation of ownership in a company, entitling you to a share of its profits and assets. Understanding this fundamental distinction is essential. When you buy a stock, you're investing in the business behind it. Your returns are ultimately tied to the company's performance and profitability. I'll share stories from my own investment journey to illustrate the significance of this perspective. My investments in companies like the Coca-Cola Company and See's Candies weren't mere bets on stock prices, but long-term commitments to the underlying businesses. We'll discuss how this mindset has allowed me to reap the benefits of compounding over time, multiplying my initial investments many times over. Additionally, we'll explore the consequences of treating stocks as pieces of businesses. It encourages investors to think like business owners. It means considering factors like the company's competitive advantage, management quality, and economic moat. This mindset shift elevates the level of scrutiny and due diligence investors apply when selecting their stocks, resulting in more informed investment decisions. Furthermore, embracing this perspective has another important implication: a long-term horizon. As an owner, you're interested in the business's long-term growth rather than the stock's short-term fluctuations. The focus shifts from trying to profit from quick price swings to nurturing the business's profitability over time. We'll discuss the patience required for this approach and how it can lead to substantial returns. I'll also emphasize the critical role of risk assessment. When you treat a stock as a piece of a business, you become more discerning about your investments. You want to be confident that the company's business model is robust and its competitive position is secure. This leads to risk reduction, ensuring that you're less prone to investing in speculative or volatile stocks. But what about diversification? You might wonder, does this mean putting all your eggs in one business basket? Not necessarily. Diversification remains an important risk management tool. It means spreading your investments across various businesses to reduce your exposure to a single company's performance. However, the mindset shift encourages you to invest in companies you truly understand, even if that results in a narrower focus than traditional diversification models. In the final part of this chapter, we'll talk about how you can practically implement this golden principle in your investment strategy. I'll provide some tips and guidance on identifying businesses you understand, conducting research, and staying committed to this principle. Identifying businesses you understand might seem straightforward, but it requires a deep, thoughtful analysis of your own knowledge and areas of expertise. I'll guide you on how to assess your circle of competence, recognize your strengths, and differentiate between what you genuinely understand and what you merely think you do. Research is a fundamental aspect of investing. I'll share my approach to researching businesses, including the key metrics and factors I consider when evaluating a company. You'll learn about the importance of assessing a company's competitive advantage, financial stability, and management quality. Staying committed to the invest in what you understand principle can be challenging, especially when market trends and emotions come into play. I'll provide insights on how to maintain discipline and focus on your core principles, even in the face of market fluctuations and external pressures. Moreover, I'll discuss the role of diversification within the scope of this principle. While it's essential to invest in businesses you understand, diversification can further reduce risk. I'll explain how to strike the right balance between a concentrated portfolio of familiar businesses and diversification. We'll also touch on portfolio management techniques, such as setting up a too-hard pile, a concept that can help you avoid unnecessary complexity and risk in your investments. This strategy aligns with my preference for businesses that have straightforward, enduring competitive advantages. These detailed discussions and practical insights will equip you with the knowledge and the mindset you need to make informed investment decisions based on the first golden principle. Invest in what you understand. Your journey towards successful investing begins with understanding and implementing this principle. In wrapping up this chapter, I want to emphasize that invest in what you understand is a timeless principle that can serve as a solid foundation for your investment journey. By dedicating yourself to this principle, you'll be well on your way to making informed, rational investment choices. The real power of this principle lies not just in its simplicity, but in its profound impact on your long-term financial success. It's about the power of knowledge, prudence, and discipline. I encourage you to continue expanding your understanding of businesses, to think like an owner, and to stay true to your circle of competence. Thank you for joining me in this discussion, and I look forward to exploring more of my principles and philosophies in the chapters to come. Don't forget to like this video, subscribe to our channel, and hit the notification bell so you never miss an episode. Your support keeps us going, and we're excited to have you with us on this journey to explore atomic habits.